Everyone's waiting for 2021 to repeat. They're watching for the blow-off top, the parabolic run, the moment when your neighbor starts texting you about altcoins at Christmas dinner. Retail traders are analyzing the same charts, looking for the same patterns, expecting the same explosive moves that minted millionaires 4 years ago. Here's the problem. They're watching for a movie that already played. They're using an old playbook for a completely different game. 2026 won't look like 2021. Not even close. The players are different, the infrastructure is different. The entire structure of how capital flows into crypto has fundamentally changed, and that's not bearish. It's actually the most bullish signal no one's paying attention to. Because while retail is waiting for history to repeat, institutions are quietly building the foundation for something much bigger and much more sustainable. The biggest shift nobody's talking about, where liquidity comes from. In 2020 and 2021, the Fed was panicking, emergency stimulus. The crypto rally was built on fear-based liquidity, the kind of capital that floods in when central banks think the financial system is collapsing. That environment created explosive moves. The Fed's balance sheet ballooned from $4 trillion to $9 trillion in less than 2 years. Money flooded into crypto. Every Jerome Powell announcement sent Bitcoin up or down 20%. 2026? Completely different. The Fed ended quantitative tightening December 1st, 2025. Balance sheet stabilized at $6.57 trillion. Reserves sitting around $2.89 trillion, just above the threshold where money markets get stressed. Think of it like switching from emergency generators to solar panels. Emergency generators are loud, dramatic, temporary. Solar panels are boring, predictable, sustainable. They keep the lights on without chaos. That's 2026 liquidity. No dramatic money printing, just steady balance sheet operations. Here's what Wall Street doesn't fully get. Explosive crypto moves don't come from chaos anymore. They come from stability. When institutions can model liquidity 6 months out, when CFOs can justify crypto positions without worrying about Fed policy changing next week, that's when real capital shows up. Patient capital that sticks around. Retail thinks boring markets are dead. Institutions know boring markets are allocatable, which brings us to the second shift, volatility compression. Bitcoin's 30-day implied volatility hit 36.5% in August 2025, lowest since October 2023, when Bitcoin traded below 30,000. Bitcoin tripled in price, and volatility went down. That's not how crypto used to work. Price and volatility always moved together. Bull markets meant wild swings. Your portfolio could move 15% in an afternoon. But in 2025, something matured. Bitcoin stopped acting like a high-growth startup and started acting like a macro asset. Like gold or currencies that institutions understand. Why? ETFs and institutions. BlackRock's iBit took in $25 billion in 2025, even during negative returns. Institutional investors kept buying through a drawdown. That's not momentum chasing. That's strategic allocation. Covered call strategies, yield programs, options overwriting. These tools actively dampen volatility. The 30 to 50% corrections we see now used to be 70 to 80% crashes. Retail sees compressed volatility and thinks the market's dead. They're waiting for the vertical move where Bitcoin goes from 90,000 to 120,000 in a week. Institutions see the same action and think, finally, an asset we can allocate without our risk committee panicking. Galaxy Digital noted Bitcoin's volatility smile now looks like large cap tech equities. That's not a crypto pattern, that's a mature asset pattern. Mature assets attract serious, long-term capital. But here's the signal that confirms we're early. Retail is completely missing. Google searches for Bitcoin, back to June 2024 levels. Coinbase app, 15th in the US App Store finance category. During 2021's peak, Coinbase was the #1 downloaded app in the entire App Store. Bitcoin touched 104,000 in December 2025, and retail interest hit unprecedented lows. No TikTok FOMO, no family group chats about crypto, no gym conversations about Dogecoin. The mainstream media isn't even covering it. This is the complete opposite of 2021. Institutions are accumulating at scale. Retail is asleep. That's not bearish. That's the definition of early. Think about a restaurant opening. Early adopters show up first. Food bloggers, insiders. They fill tables while most people don't know it exists. Then word spreads. Then lines form. Crypto in December 2025, early adopter phase. Institutions are seated. MicroStrategy holds 671,000 Bitcoin, 3.19% of total supply. Abu Dhabi's sovereign wealth fund invested $450 million in Bitcoin ETFs. The US is exploring a strategic Bitcoin reserve. Professionals are here, but retail? Still at home, waiting for someone to text them that lines are forming. By the time Google searches spike and Coinbase hits #1 again, the early seeding's gone. And that's the most dangerous assumption, expecting the next cycle to look like the last. Same asset class, different structure. In 2021, the cycle ran on retail FOMO and absurd leverage. Exchanges offered 100x margin to anyone with an email. People bought dog coins based on Elon tweets. The market ran on emotion and the greater fool theory. 2026 is institutional infrastructure. ETFs with $118 billion in inflows. Covered call vaults, institutional custody, sophisticated hedging. These aren't degen plays. These are portfolio management tools built by teams with risk models and compliance departments. The timeline's different. 2021 moved fast, parabolic, 18 months from late 2020 to mid-2021. Then look what happened. 70 to 80% drawdowns. Luna imploded, 40 billion gone overnight, FTX collapsed. Three Arrows Capital liquidated, triggering chain bankruptcies. Price went vertical because the structure was unstable, built on leverage, hype, unsustainable promises. When the foundation cracked, everything collapsed. 2026 builds differently. Slower accumulation, longer grind-ups. 30 to 50% corrections, not total wipeouts. Less exciting weekly, more sustainable yearly. Fireworks versus infrastructure. 2021 was a pop-up restaurant. Huge hype, influencers, lines around the block, closed 6 months later, no foundation. 2026 is franchise expansion, slower rollout, no champagne and celebrities. But every location has infrastructure. Training, systems, doesn't make headlines, lasts, scales, builds generational value. Markets evolve faster than expectations, and right now, the crypto market is evolving into something most retail traders won't recognize until it's already too late. Until the easy money's been made and they're buying the top of the next cycle, wondering why it feels different this time. So what does this all mean for you? Liquidity is shifting from panic-driven emergency measures to predictable, stable balance sheet management. Volatility is compressing. As institutions smooth out the extremes with sophisticated hedging strategies, retail interest is missing, which means we're early in the cycle, not late, and the entire cycle structure is maturing into something sustainable and durable rather than explosive and fragile. This isn't the setup for another 2021-style blow-off top. This is the setup for something bigger, longer lasting, and more structurally sound. The players are different, the tools are different, the pacing is different, the infrastructure is different. And here's the final insight. The people waiting for 2021 to repeat, they're watching for fireworks while the foundation for a skyscraper is being poured. They want the excitement of a pop-up restaurant while a global franchise is being built. They're looking for the next meme coin moonshot while institutions are quietly accumulating the hardest money ever created. The question isn't whether crypto will move in 2026. The market is already moving. Capital is already flowing. The structure is already being built. The real question is whether you'll recognize the move when it happens. Because it won't look like last time. It never does. If this analysis helped you see the market differently, hit that like button and subscribe to stay ahead of the trends everyone else misses. This is Crypto Nomad. See you in the next one.